SEBI introduced real estate investment trusts and infrastructure investment trusts, also known as REITs and InvITs, in India in 2014. Both are investment vehicles that pool money from multiple investors and have a sponsor or a trustee. So, what exactly are REITs and InvITs? Well, REITs are like mutual funds for real estate. They pool money from investors to buy, operate, and manage income generating properties such as malls, office buildings, and apartments. InvITs, on the other hand, invest in infrastructure assets like highways, power plants, and telecom towers. REITs and InvITs work by offering units to investors. When you buy units, you become a part owner of the properties or infrastructure projects held by the trust. You receive a share of the rental income or toll collections and any capital gains when the properties or projects appreciate. You can invest a minimum of 10,000 to 15,000 rupees or a price of one unit on the stock exchange with no maximum limit to your investment. Investing in REITs offers diversification as you can invest in a range of properties with a relatively small investment. They provide regular income through dividends and their share prices may also appreciate over time. They're managed by professionals, so you don't have to worry about property management. InvITs offer exposure to critical infrastructure projects, often with long-term contracts and predictable cash flows. They can provide stable income through distributions and potential capital appreciation. They also allow you to invest in large infrastructure projects without the hassle of direct ownership. After you decide the ones in which you wish to invest, you need to open a trading account as well as a demat account, after which you can purchase and sell units listed on the stock exchange. You would require your Aadhaar, PAN card, and bank account statements. But investing in them is risky, with no guarantee of returns and a possibility of permanent loss of capital. REITs may be sensitive to economic conditions and property values can fluctuate. InvITs may face regulatory and project-specific risks. Additionally, both can be affected by interest rate changes. Also, their liquidity is currently low, so one may not be able to exit in an emergency.
Think of it like a house or think of it like any other asset where you are getting a periodic rent on that asset, and when that asset will be sold, you will be able to realize some capital gains as well. Something was bought for 100 rupee, it will be sold for 150 rupee, and while the period you are holding it, you will keep getting rent on that 100 rupee. So if this is your requirement, people should invest. But I would say that investors should not invest in REITs and InvITs simply because we have very few of them. The market is not evolved. They are trading at a steep discount. They might look attractive, but if they continue to remain attractive even when you want to sell it, it will be undesirable. So give it some time. These are early days for REITs and InvITs, and I would say that let it mature, let it evolve. Let us have some few more.